founder and head of research. He is here, as I said, at Post 9, and it's great to see you in person.
Yeah, great to see you, Scott.
But what you said was your first in-person interview since 2019.
That's right. So, for the last 3 years, everything's been virtual.
Well, it's good to have you here.
Yeah.
And look, you told me the other day, you admitted that you've been a little too bullish at times on stocks, but yet you sit here today and you continue to make the case that they can go higher.
Yes, I think stocks are definitely going through a very difficult period because we know the bond market is quite hawkish and the Fed has to, sort of meet market expectations there. And we know that consumers going to be taking a pretty big hit from commodities and fuel. But if we avoid recession, which is our belief, then stocks have discounted more than a recession. Because when we look at investor positioning, institutionally, they have more cash than they did in 2009. Consumer confidence is as low as it was in 2009. And then if you look at retail sentiment, it's as bad as 2009. So people are pricing in, I think, a calamitous scenario, and that's when stocks can start to rally.
I mean, isn't it just a matter of time, though, before earnings slow, before the consumer start spending less? I mean, how can all of this not transpire in the kind of backdrop that we have? Extremely high inflation, a hawkish Fed, et cetera, et cetera, et cetera.
Yeah, it's a great question, and we won't know for a few months. That's, I think, what stocks are going to sort of be worried about.
But isn't that the base case? Isn't that the base case, that earnings are going to slow, the consumer is going to slow, the economy is going to slow, by the very nature of what the Fed is going to do?
That's exactly right. But that's also why 40% of stocks are in a bear market. So I think the market has now said over half of the S&P should be derated by 20%. And we know that consumer balance sheets are in great shape. Goldman had a great report showing that even in the bottom 2 quintiles of income, they have 12% excess savings right now. And if consumer debt levels, which are really low, means you may not see a contraction even though prices are high. So we could see a positive surprise coming out of the consumer. And war times are generally good for economic growth. So I actually think we could have some positive surprise in the second half. So I think if, as much as people worry about things getting bad, things could actually get better.
Let's talk about this current rally that we've experienced, today notwithstanding. What's it about? Are these real buyers? Is it reliable? Is it simply short covering? Bear market bounce? What is it?
To me, if I guessed, it feels like position squaring. I think people got bearish, went to cash, and then they realized things are so bad that you have to be somewhat re-risked. I don't think there's a lot of conviction. I think today's an example of that. But we can see leadership, too. I mean, basic materials is a structural long. And then I think we're seeing, as you guys were talking about, some pretty good relative performance of things like FANG. So I think FANG is going to be one of the groups that people realize doesn't get hurt by higher prices, and the multiples have come in, and the second half they're going to be, I think, really strong stocks.
I mean, if you talk about, changing positioning, that has a connotation with it that it's a longer lasting potential move. This is not simply short covering. It's literally people changing positions because they got too bearish.
That's right. In fact, Ryan Detrick actually has some great stats. This looks a lot like the position squaring that took place on April 2020 and 2009. So in a way, people got into a deep recession position. They need to re-risk, but then there's better resilience, and then suddenly people want to buy stocks again. I don't know if we're at that point. It might take a couple months, but I think stocks are definitely surprising to the upside.
I think one of the principal parts of your narrative is that inflation, as bad as it has been and as bad as it remains, could be rolling over. And you look at a freight index. I want you to explain why that's important to you and why you flagged that as a principal thing you're looking at.
Yeah, and it's a little complicated, but the inflation that we saw last year was due to supply chain glitches. So let's say that was the event was movement of goods, and Cass Freight Index is a measure of that because it skyrocketed. Well, that's rolled over so sharply, it's now a negative year over year. And historically, that leads CPI by 6 months. So I think the goods inflation that we had hitting us last year is now diminishing. This year, what we're dealing with is now this spilling into services and now oil risk. But if those actually start to plateau, then we're sort of saying the inflation picture is probably a little better than the Fed was worried about, and that's kind of a dovish development.
What if I say, okay, but labor costs show no sign of slowing down, and we know where borrowing costs are going to? That's going to slow corporate activity.
Yes. Ironically, in a borrowing costs haven't risen as much as inflation. So actually, the cost of money has gotten cheaper this year. So we're actually more negative real rates. Today, if you borrow money, you're borrowing it at negative 5%. So it's almost positive for corporates to borrow money today because they can earn more money. That's actually good for risk assets. Historically, that's when stocks can actually see PE expansion. So as bad as it sounds, it's actually marginally positive.
Look, you need to make calls at times when the world seems uneasy. You can't wait for the market to, be at all-time highs to say, yeah, I said we're going higher. So I totally get it. I just wonder if, in some respects, you ignore some of the risks that are on the table that may be insurmountable. As I was discussing with Adam Parker, the Fed is going to be aggressive.
Yes.
We know that. And by virtue of the move that we've seen in the market, and if it does continue, don't they get emboldened by that?
Yeah. I mean, the market's pricing in 7 hikes. That's consensus. That's what the Fed futures are saying. If there are fewer hikes, as Adam was referring to, that's a positive development because we're going to be reaching the end of that hawkish cycle sooner. And of course, rates could be capped a lot sooner. Our technician, Mark Newton, thinks the 10-year is going to sort of hit 250 and then actually start to descend. That will be good for PE as well.
Hey, look, Scott Minerd was on in the first couple of days of these new programs and suggested 2.25. I mean, maybe that becomes the top on the 10-year. So he's not the only one thinking that. If, in fact, that is the case, what does it mean for the tech trade?
It's great for the tech trade because now you're paying, 45, almost 50 times for a bond. Face Meta at 16 times looks like a bargain. I think the idea of TINA comes back strong in the second half, and especially owning U.S. stocks. I mean, it's probably the safest place to put money today. I wouldn't really, if I was an Asian wealthy person or a European wealthy person, I'd be putting capital in the U.S.
Quickly, how quickly are you focused on a stock like Apple, which we had made the point, and I just did with Pete Najarian, the move that it's had from 150, which was really a perilous point. And we noted that on the very first day of Overtime, that you have to watch what's happening with Apple, the biggest stock in the market. You can't have that breakdown. Well,
that's right.
It's gone the opposite direction.
Yep, that's right. It's a bellwether. It's a great company. It's now acting very strong, and it's kind of benefiting from supply chain easing. So I think in a lot of ways, if Apple's strong, I don't think you can be that bearish on the S&P.
All right. It's great to see you in person.
Yeah, great to see you, Scott.
Yeah, thanks for coming down to Post 9. That's Fundstrat's Tom Lee. We have breaking news now.